Hey, welcome to the Whaley trading course, The Base. In this course, I want you to get a real perception what is the market is without those pink glasses that most of people might have because they saw a few guys with rented Lambos with a bunch of money on the tables that are talking BS about trading. In this course, you won't hear anything about things that don't work or just take away the main asset from you, your time and your focus. I have done my best to explain all crucial things in the most simple way that even a toddler would understand what I'm talking about, because I strongly believe that if you can break down all complex things into simpler ones, it means that you are delusional or you just overestimate your knowledge. Also, if you are already experienced trader, it would be great for you to refresh your knowledge about functionality of the market, on which things you have to pay attention to and what situations are better to skip. What is more, I created a bonus section to this course where I explain what trading rules you should have. It's a list of trading rules that every trader should have if you want to become a profitable trader. Trading plan, how to get prepared and execute your trade perfectly, and trading time, in what time it is better to trade. So if you want to receive this bonus section, all what you have to do is just leave a meaningful comment under this video, but not just one word like a good, thank you, nice, just one sentence, few sentences, and then reach out to me in my Telegram or Instagram, and I will send you this bonus section. I invested a huge amount of time, energy, and knowledge into creating of this course, so it's the only request that I have for you. Also, if you want to get a cashback from your trading fees, read the information in the description. So if you're ready, let's start.
So first of all, I created this course with the idea that it should be so darn good that if I was just starting my journey in trading, it should save me more than 1 year of my suffering and losses. Because when I just started, I had a really tough, hard times. I didn't know what the trading system is. I didn't know how the market works. I didn't know the mechanic of the market. I just didn't know what I didn't know. Yeah, and nowadays many gurus are selling courses with basic information for $200, $500, $1,000, and for me it's silly, it's just insane. That's why I created this course for you for free, because I believe that everyone should have a free access to the real useful information, to the fundamentals of trading. But if I say that this information is fundamental, it doesn't mean that it is basic or unnecessary. It's just crucial information that every trader should have. If you want to become a profitable trader, you should know this information. This course gives all the answers to questions that you might have at your initial stages. So let's rock. So one more time, why did I create this course? Everyone deserves free, good base to get started in trading. I want to bring clarity and give you the real understanding in what is trading without BS and fairy tales. I want to help as much people as it possible. What information does this course provide? Trading is efficient when it is simple, because hard, difficult stuff doesn't work and only creates overwhelming. As a result, you don't know what to do, how to act, what things you should pay attention to, and etc. Trading brings money only when it is simple, when you understand what you are doing and know what is right and what is wrong. That's why I made a huge effort to structure all the information in the most simple way. I split the course into 4 main parts. First one is understanding what is trading, information that has to know every trader. Second, analysis, how to analyze information that we get. Third, how market works, how it works, and how to use it for your sake. And fourth, concept of making money, what really brings money. Trading is the hardest way to earn easy money. It's a perfect quote that describes trading. On the other side, it seems extremely easy. You just click a few buttons and get money into your pocket. But in reality, you have to go through a lot of shit. To be honest, every profession or business is hard. If you are an entrepreneur or engineer or accountant, lawyer, you had hard times, difficulties, and stress. So if you want to dive into the world of trading, it is important to keep going and don't distract yourself with shiny objects like Amazon FBA, dropshipping, I don't know, marketing agencies, and etc. There is always a greener grass on the other side of the river, but when you will get to the other side, you will discover that that side has more shit than your side. So it's just a life. And the path of successful trader is not an easy walk on the sandy beach of Bali, but with the right approach, common sense, and knowledge, it's a path that totally worth accomplishing and you will never regret it. So if you decided to make a living from a trading because there is unlimited potential of earning ability, just stick to your commitment and you will succeed. On my side, I promise that I will do my best to reduce that shit on your side of the river and make your life better. So what types of trading do we have? Scalping, trading with professional terminal with order book. Second one is day trading. In the end of the day, all your positions are closed. Third is swing trading. Your positions are open from 2 days to a few months. And fourth, investing. Your positions are open within few months or years. I want to say a few words about scalping, because as for me, scalping is a trading on financial markets, intending to get profit on the difference of prices by buying or selling through analysis of chart and order book of asset. Why order book is so crucial? By using the only charts, you don't see a crucial information such market activity, you don't see big orders, aka densities, you don't see market inefficiency and etc. But the order book in turn gives the possibility to get that data. So as for me, scalping it's a trading only with the order book. Always should know what trading requires. First of all is clarity. You have to know what you are doing. Be in shape, act consciously and cool. Second one is PC or laptop. Minimal requirement for terminal installation plus connection to the internet. Third, minimal deposit. $50 is enough to start. I started from $40. Fourth, fine motor skills. In scalping, you need fast reaction. It would be fine if your age is below 50 years old. If you have experience of gaming, for example, Counter-Strike or whatever shooter, it will be a huge benefit for you. What do you need to know? Trading is not as easy as it looks. As I said before, trading is the hardest way to earn easy money. What you should search on chart? It can be volumes of candles, it can be patterns, certain situations in general. What you should search in order book? It can be algorithms, densities, aka big orders, and etc. The mechanic of the market, it's very important. You can't just choose a random asset and start to trade it, because strategies that work on one asset or market might not work on the other one, and you will lose your money by trying to apply the same approach to totally another thing. The last one is you, yourself, your psychology, because you should know what you are capable of, what are your limits, what is your edge, in what conditions you can control yourself, and etc. Maybe you have a darn good question: does shortcuts exist? In most cases, shortcuts make only negative impact, or they are just a scam. But to be honest, there are 4 shortcuts. First one is conscious trading. In the early stages, take it for a rule to know or just understand what you are doing, because the situation such, because something occurred to me at that moment and I opened a trade. No, sorry, but just forget about this, okay? You have to know what you're doing and you should have a real confirmations. Second one is practice. Practice, hone your skills, practice. How we can become better surgeon, for example. Yeah, you have to make 1,000 surgeons. How the sportsman can become a champion only by going on training and spend a huge amount of hours with practice. How we can learn how to drive only by driving X amount of time, for example 100 hours, 1,000 hours, I don't know really, because it's only depends on you, but you have spent a huge amount of time just by driving. You need a practice. You can't learn boxing only by reading books about boxing. It's silly, yeah? Imagine that situation that tomorrow you will have a fight with dude who spent last year only practicing boxing. He practiced boxing every day. He went to every training. Every day he had a sparring. Every day he honed his skills, his movements, punches, etc. And on the other side is you who read 20, 30, 40 books about boxing, but you don't have a single day of sparrings. Guess who will win in that fight? What a mystery, yeah? I think the answer is obvious. Third is community. Find somebody who already accomplished what you want. I can tell you how much you can accomplish if you start to learn from somebody who already achieved what you want, who can tell you what to do, how to get faster results, how to get the knowledge without a scar. It's a huge advantage over other participants, over other people, and it's not only about training, it's about life at all. Because if you want to learn the same story with boxing, how you can become a fighter without a good coach or trainer, it's impossible, yeah? So how many cars you will crash before you will learn how to drive without a good coach? The answer is obvious, yes. So it's a huge boost if you will find a community with like-minded people, or you will find a good mentor. So just spend some time and find a really good source of information and stick to it, okay? It's nuts, it's a gold, it's a real shortcut to your success. And the last one, get rid of bad habits. It will be good for you not only in the trading field but also in your personal life. Quit smoking, drinking, quit from toxic relationships, toxic environment, etc. Because all these things take away your time, your money, your focus. Start going to the gym or doing some kind of sport. Sleep more and better. It is crucial in training because your inner peace and your health take a huge role in your success in training. What are your chances to execute perfectly your setup, your trade, if you are always in bad mood, you are tired, you have a foggy head, and you can soberly evaluate the situation on the market? Your chances to succeed in trading are zero. So please take care of yourself, okay? And here we can see the quote that I love so much: your work works more on you than you need. It means that all those efforts, all those hours count. I know that sometimes when you try to learn a new skill, it's really tough, because how the process of learning skills look like. Firstly, you have a huge gain to your knowledge, because you are at zero level. Yeah, you know nothing, and you start to learn new skill. And I promise, for first 20-30 hours you will gain a huge amount of knowledge, and you will never have such gains in such short period of time in the process of learning this certain skill. So for example, you learn, let's take example of the training. Yeah, first 20 hours you will learn so much information. You will know what is the exchange, you will know what is the market, what is the mechanic of the market. You will learn how to open the long position, the short position, what is the difference between futures and spot. You will learn what buttons you have to click in your terminal to open, close your position, how to place your limit order, how to open market order, where is stop, limit order, etc. So it's a huge gain in short period of time. And if you will take a chart, it will be like a pump in skyrocket skill. Yeah, so you will learn a huge amount of information. Then you will have a plateau, like you will think that you don't have any progress, but in reality you just gain new information, and you develop your skill, because okay, you will learn all that stuff, all that information, but you don't know how to learn how to earn money. You don't know how to implement that information to get money to your pocket. So it's a stage of stagnation, it's a plateau phase, and at that phase it is hard to realize that you have a progress. You really have a progress, because you gain more knowledge, you gain more information, you learn how to implement that information that you already have, and it's tough. Yeah, it's really tough when you don't see any progress and you spend a huge amount of time by practicing in that field, and sometimes it will take 1 month, 3 months, maybe half of the year, 1 year. All depends on in what conditions you are. If you have a community or mentor, of course it will be faster, but if you are trying to figure out on your own, it can take 2 years, 3 years, and it's this stage of plateau. You gain that knowledge, but you don't have enough information, enough practice to go to the another level. And as I said, it's hard, but don't give up. Yeah, it's human nature. It's a silly human nature that when we don't see any progress, we want to give up, but it's not right. You have to keep going, really, because in some moment you will break that roof and you will go to the another level. You will start to earn money, and you will understand that all that hours, all that efforts count, and without that suffering, without those losses and shitty situations, you won't succeed. You have to go through that shit to get what you want. So clench your teeth and keep going. I believe in you. You can achieve it. And last shortcut that I can offer you is believe in yourself. I said this before and will say this again. I believe in you, but this seed of belief must be in your heart, in your head, in your brain. It's maybe the most important thing. Without believing, all knowledge and practice just doesn't matter. Believe that you are capable of becoming a trader, because as in every aspect of our lives, there will be always some obstacles that we have to overcome. And just remember one great phrase: you lose only when you stop trying. You lose only when you stop trying. So keep going, my friend. Finally, we get to the market. So, what is it? It's a composition of systems, institutions, procedures, social relations, or infrastructures whereby parties are engaged in exchange. In general, there are many markets, their divisions, subdivisions, types, subtypes. I don't want to dive into this information because it's not so important. I want to give you only a crucial information that will help you to earn money. If you want to find more information, you can go to Investopedia or Wikipedia and just read that information. You just need to know that we have a capital market, commodity market, money market, future market, spot market, derivative market, and of course cryptocurrency market. We are interested in cryptocurrency market because there we exchange digital currency. Okay, now we know what is the market, but what is the exchange? It is a marketplace where securities, commodities, derivatives, and other financial instruments are traded. So, in general, it's just a place where sellers and buyers accomplish their exchange of the asset. The core function of an exchange is to ensure fair trade between two sides, buyer and seller. Exchanges give companies, governments, and other groups a platform from which to sell securities to the investing public. The exchange profit is the commission that it takes for operational execution. There are several global exchanges: New York Stock Exchange, Chicago Mercantile Exchange, American Stock Exchange, aka Nasdaq, Moscow Stock Exchange, Tokyo Stock Exchange. And you have to remember that every exchange has its own trading, aka working time. Now we know what is the market, what is the exchange, but how we can start to trade. In stock market we have three options. First one is a broker. It's a person or firm who arranges transactions between a buyer and a seller. This may be done for a commission when the deal is executed. So in other words, it's just a middleman between buyer and seller, and he takes his profit, aka commission, for operational execution. But here you trade with your own money. Second option is a proprietary trading, when a trader trades financial assets with the firm's own money to make a profit for itself. So here we take money from another firm and trade with those money. Like from first glance, it's a great option, but I had a bad experience with that kind of trading because proprietary companies have a strict rules. When you violate them, you lose your deposit. Second problem is it's my problem, because when I had 5 or 7% of profit from the deposit that I got, they said you can't withdraw the profits, you have to make 10% and only then we can give you a money. So it's silly. They always expect that you will fail. So I don't like this option. And last is on your own. Everything falls on your shoulders. Here you have to spend a lot of resources like your time, your energy, your money to create an access to the exchange to just be able to conduct financial activities. So it's the most hard way to trade. Fine, now we know how to start trading in stock market, but what about crypto market? Here we have the same three options. First one, it's on your own, and it's the most simple. We just create an account on whatever exchange you want, Binance, Bybit, deposit even at $10 and start trading. That's all. That's all. The threshold of entry is so low. That's why the statistic of successful traders is also so low. And second one is proprietary trading, as I said before, as was with stock market. when a trader trades financial assets with the firm's own money to make a profit for itself. So we take money from another firm, company, we trade with those money. Maybe we will make a profit, maybe no, but when we have a profit, there are always some tension between trader and company. And to be honest, I don't recommend to trade with proprietary trading if you have money, but of course you can try. Third is a broker. It's a person or firm who arrange transactions between a buyer and seller. As I said before, it's the same as what with stock market, just a person who gives an access to the exchange and takes a commission for operational execution. That's all. What market participants do we have? We have buyers and sellers. The process of buying or selling can create a disbalance on the market. That's why the price can move up or down. When the market is in balance, it means that resources of buyers and sellers are the same or equal. The price moves in a very narrow range and we don't see any significant movement. This balance comes when one of the sides has more power, aka those financial resources, money, to buy or sell the assets. So that's why we see pumps, dumps, and other big market movements. You may hear from me or other traders or from social media, etc., that on the market we have a huge amount of participants, aka players, like hedge funds, banks, institutions, market makers, etc. For us, it doesn't make any sense because we just don't know who stays behind every transaction, who sold, who bought. Only exchanges know this, and I'm more than convinced that they sell that information for crazy money for interested parties. As I said before, for us it doesn't make any sense, doesn't make any difference who moved the price. Yes, we just interested in the fact that it was moving. For us there are only buyers and sellers. Fine, now we know that on the market we have big participants like banks, institutions, hedge funds, and market makers. What about small participants? Small participants are retail traders who are divided into humans and robots. With humans, I hope is all understandable. What about robots? So algorithms are robots, or in other words, code programs that were created to do certain actions in the market. Many banks and institutions use algorithms to replace human labor in aim of reducing operational costs, salary, insurance, taxes, etc. I have to admit that those algorithms can work in teams and groups and create a huge manipulations on certain assets. But it all depends on how much resources, aka money, they have. By knowing this, we can determine exactly which category the algorithms belongs to. They are divided into a few types because of their functions. For example, buyer, seller, screwer, substitute, updater. There are much more complicated robots, but these are the most popular. You just have to know that they exist. Now let's talk about positions in trading. We have long and short. Long, the purchase of an asset with the expectation it will increase in value. Short, the purchase of an asset with the expectation it will decrease in value. So with the mechanic of the long, I think all is clear. For example, we buy a box of apples for $5 and we expect that on next week the price will be $10. So we can sell for $10 and our profit will be $5 per box. The mechanic of short is a little bit different. In short position, you borrow from the exchange a certain amount of asset. Then you sell it with the expectation that the price will go lower to buy it by cheaper price and give back the borrowed amount to the exchange. The difference in prices is your profit. I know that it seems to be very complicated, that's why I created an example. You go short with apples. So technically you borrow the apple from exchange and immediately sell for market price. For example, $10. Yeah, market price of the apple is $10. Now you have $10 on your hands. You wait until the price will go lower. For example, $8. Now you buy the apple for $8. You have $10 and you buy apple for 8. So the difference is $2. You bought the apple, then you give back the exchange this apple, the asset, yes? And now your profit is $2. I hope it's clear. So now we know what positions we have in trading. We know the difference between long and short, the mechanic of each position. So let's talk about the order book. It's a tool that shows you an amount of contracts in long side, bid here, and short side, ask at a certain price here. On the left side of order book, you can see the amount of asset, aka orders. On the right side is a price by which somebody wants to buy or sell the asset. So for example, here somebody wants to buy 403. It's like not one person, but it's just a summary of orders by $73.68. We can see market orders that execute immediately in the tape. So here is the tape, and here you can see how somebody immediately buy or sell the asset by market orders. Spread in order book. It's a gap between the lowest price for selling and biggest price for buying. Between them, there is no order, so the price moves rapidly from one side to another. So this gap is a spread in order book. There is no any order, so price just rapidly moves from one side to another one. And of course, we have to talk about orders that we have. First one is market order. Executes immediately by first best price. So if the price of Apple is $10 for now, current price, market price, your order will be fulfilled at this price. If the market price is $10.02, so your order will be fulfilled by $10.02, and your entry point will be $10.02. I hope this is clear. Limit order. Executes only by chosen price. For example, the current price, the market price of the Apple is $10. You place the limit order in buy section lower at $8. So $10 and $8. And when the price will reach $8, your order will be fulfilled and you will open your position for $8. So basically you will buy an Apple for $8. If you want to sell, the current price is $10 and you want to sell at $15. So the price will rise if it will grow. And as soon as price will reach $15, your order will be executed and you will sell your apples. Next one is stop limit order. Is executed by trigger price. In general, it's the same as limit order, but it has the trigger price. So for example, the current price of Apple is $10 and you want to place your order only when the price will reach $11. So firstly, we have the price $10, and when the price will reach $11, your order will be placed at $15. And only then, when the price will reach $15, you will sell your apples. So here you can see on screenshots how those orders look like in order book. First one is market order. You just click buy or sell and you will see your order immediately in a tape. Limit order, you place your limit order lower or higher, and when the price will hit your order, you will open your short position or long position. Stop limit order: when the price will reach a trigger price, the exchange will place your limit order, and if the price will reach your limit order, you will execute your trade. I hope it's clear. Also, let's talk about take profit and stop loss. Take profit: common limit order that will close your position in profit at the moment when the market price will achieve it. Stop loss: common limit order that will close your position in loss at the moment when the market price will achieve it. So in general, they are simple limit orders that adjust the volume of execution to your current volume in your position. So it will be always fully closed when the market price will achieve your orders. Why it's so crucial? Because, for example, you entered in position for $1,000 and you place it, your take profit and stop loss. And for example, after some moments, some time, you close a small part of your position, for example 300, and now you don't have $1,000 in position, only 700, and your take profit and stop loss also change the amount of orders. So now their size is 700, not 1,000, because if you place it as common limit order, it also will have 1,000 as at the beginning, and when the price will hit, for example, your limit order at 69.64, you don't close your position fully, but you will go short for $300. I hope it's clear. How is the price formed? The price of the asset is formed by combining limit and market orders. You should remember that price is always driven by market orders because they are dynamic, unlike limit orders that are static. Here I have to add that the trade is executed when the order takes a liquidity from the order book, only then. All orders are executed according to the Q rule. If you click to execute a market order at the same time as another trader, the exchange will activate the order faster with the one who has the lowest ping. Ping, it's a time, you can see it here in the right corner. So what is the ping? Ping, it's a time that is required to send a request from your laptop or computer to the server of your exchange. Then the exchange can process it and fulfill your request. So basically it's just time of reaction between button click and answer from exchange. Let's talk about liquidity. What is liquidity? Liquidity is the efficiency or ease with which an asset can be converted into cash without affecting its market price. The more liquid an asset is, the more efficient it is. You won't see huge squeezes on Bitcoin or S&P 500 because there is so much liquidity that it is possible to create empty space in order book. So in other words, liquidity is the amount of asset that is accessible for execution of sales or purchases. The less liquid the asset is, the harder is to execute your trades with relatively big volumes. Low liquidity creates huge volatility, and volatility is big oscillation of the price in short period of time. Unliquid asset, it's the asset which has a low converting ability. It creates difficulty to buy or sell desired amount of contracts or coins. So here you can see a picture of order book of low liquidity, of low liquid asset. You can see that there is no money in that coin because here is only two limit orders, 166, and the price of the asset is only $8. So basically you can move the price just by selling the asset for 10, 12, 13 only for $200. So it's just illiquid shit For example, you want to buy this asset for even 100k, you will just create a huge squeeze on the chart like here. Squeeze, it's a rapid movement that leaves a long shadow on the chart. So for example, you want to buy this asset for 100k as the volume of 100k, and you just create this huge squeeze because you buy all those orders that are in sell direction, in sell side. For better understanding, I created the example. You want to buy 10 boxes with apples, so you have to go to the marketplace. On the marketplace, you have 3 sellers of apples. First one, let it be Muhammad. Muhammad has 3 boxes for $5 per box. So it's great price and you buy it. Now you have 3 boxes. You go to the another seller. Let it be John. John is selling boxes with apples for $7 per box. So you just buy because you don't have another choice. Now you have 8 boxes and you need 2 more. Third seller, let's say it's Jewish name, Yuda. Let it be Yuda. Yuda saw that you desperately buying apples, boxes with apples, so he decided to place the highest price because he knows that you will buy. So you don't have another choice and you buy those boxes. And now you fulfilled your order. So basically what I mean by this example. Imagine that our marketplace has the order book. So it will looks like this. It's Muhammad, John, and Yuda. Muhammad has Muhammad was selling apples, 3 boxes with apples, $5 per box. Second, John, 5 orders, $7, and Yuda was selling 2 boxes, so it's 2 orders per $8 each. So basically what you have done, there was initial price $5 per box. Price moved somehow. Then you start to buy the asset, apples. So the price increased rapidly to $7. You create a mini pump. Then it wasn't enough for you and you wanted to buy 2 more, so the price increased to $8. So basically you create a pump and here you fulfilled your order. You bought 10 apple boxes and now you can go to home and make an apple pie. What will be next? Market maker will return the price to initial value, to $5. So basically you just create, it was like a one single candle with huge shadow, and you create this inefficiency on the market. It means that this asset is unliquid. I hope it's clear. Now we get to the technical analysis. So what is it? It's analyzing the assets through the study of past market data, primarily price and volume. The main tool is a chart. There we are looking for places where other participants with high probability will lose their money. The main point of chart analysis is to find places where we will be able to take money from the market. Technical analysis has 3 pillars: chart, volumes, and the main which depends only on you, it's a perception of reality. Without it, technical analysis won't work because you won't be able to use it soberly. Tech analysis is a dry and unbreakable facts. They can be distorted. Okay? It's dry facts. A combination of tech analysis and analysis of the order book gives incredibly big chances to find the best setup where we can make profits. What is not technical analysis? It's crucial to have right awareness of what is technical analysis and what is not. Forget about guessing shitty patterns and indicators because they have nothing in common with tech analysis and real trading and lead you to huge losses. What is even worse, your skill won't grow, you will stay on the same level and waste a huge amount of time by doing meaningless things. So tech analysis it's not a game of zero where you are trying to guess where the price will go. Our mission is identify places where other participants can potentially lose their money so we can earn them. It's not a shitty common patterns like head and shoulders, double bottom, triple bottom, butterfly, alligator Gandhi, T-Rex, whatever. The price mustn't go lower after it draws a right shoulder, and it doesn't mean that the price will go higher after a double bottom. That's not working at all. Tech analysis helps us identify places on the chart where the majority of traders lose their money so we can use them for our benefit. We can make money only when somebody loses them. Remember this. We can take money only when somebody gives them, okay? The belief that all those shitty patterns, as I said before, double bottom, triple bottom, double top, triple top, head of Bart Simpson and all other patterns are simple shit. They don't work. Sorry, but they are as far from reality as Elon Musk from poverty. And if you have those false beliefs, you have to get rid of them as soon as possible because you will never succeed in trading with such approach. We never use indicators because they don't work and don't tell us where the price will go. What is more, they just invalid because they show us all data. Yes? And it's just silly to think that somebody has the indicator that has 100% of win rate or even 18% of win rate. What is the point to share such treasure with somebody if you can just make millions, billions with such tool? It's just silly. And it's super funny when somebody just sells this indicator for $20 or $50 like a subscription per month. Like, it's just silly. What I would recommend is to use only vertical volumes because they are really useful. But in general, I don't recommend to use indicators. I saw those silly charts with millions, billions of indicators where you just can't see a price. It's just silly. The price is the main. Chart was created to see the price, but those traders think that they are smarter, so let it be. And the phrase is better to know why you lose than don't know why you won. It's one of the rules of my life. With time you will understand what you have to do by realizing why you are losing. You will understand your mistakes. That's why beginners suffer so much, because they do the wrong stuff. Maybe they will earn money. For example, in 2021 Dogecoin, all what you have to do is buy and wait until the price will go up, then you sell, profit. But that's isn't working every time. It's not right. You should have confirmations. strategy. You should know where is your stop loss, where is take profit, what is the concept that you have to use here in current situation in the market on your certain asset. So it's many factors that you have to count, but they don't know this. Yeah, they are just newbie and they already earned money and they hope that it will work every fucking time, and they suffer. Their brain goes above and beyond to figure out what is wrong because it's not working. That strategy doesn't work at all. Their nervous system gets older for 5 years in 1 month. They suffer as fuck, and it's really hard for them to realize that it's not working. It's not working, and they have to try something else because our brain, it's a bitch, to be honest. And before you finally understand what is wrong, your deposit can be equal to zero, so you lose your money and you don't have resources to act with right path. Yes, so it's crucial to start your trading journey with the right information. Otherwise, it will be a big problem because our brain loves to stick to something that we used to. It's really hard to kick out old stuff from our brain and reprogram it with new information. That process looks similar to exchanging bad habits with new ones. It's hard to force yourself to eat apples when you want to smoke so bad that your hands are shaking. So that is human nature, and we have to make all possible, all what it takes to act consciously and soberly in any situation. You may ask me, what is the perception of reality? Perception of reality is when we don't have imagination, we don't have a hope, we don't believe in anything. In trading, we are atheists. We don't have feelings, we don't guess, we act by fact. So if you want to succeed in trading, you have to learn how to turn off your imagination, your hope, your beliefs, your feelings, and act strictly to your trading strategy. If you find yourself in a situation when you enter into position because, as you said, you guessed the direction of the price, you hope that, for example, you hope that your negative position will go higher and it will become profitable, and other similar phrases, things, sorry, but you don't have place here. The market will destroy you and you will lose your money, your deposits, you will lose your mental health, and etc. So just ask yourself if you can be honest with you, because otherwise the market will destroy you. Just remember, guessing equals to gambling, casino, roulette. Those actions just cause losing money. We are here to earn money, so we don't guess, we act by fact. Why the chart is so crucial? Chart shows interest of participants. It's a huge diary that shows us where and how much of the asset was sold or bought. With this tool, we can figure out where and how other people could lose their money, so we get a chance to take them. Do your best to keep your chart as clear as possible. The clearer the chart is, the more important things you are able to see. So pay attention to the left picture, left screenshot of naked chart Bitcoin. Here we can clearly see where is the support, where is the resistance, trend line, and so on. And on right side, it's just insane situation. I don't understand those people who expect to make some money on markets by using this approach to trading. It's just, you have to be insane person if you expect that you are able to make some money with such flashy stuff. It only takes away from your wishing your attention from the price. About left picture, here we can clearly see the resistance for this part of the chart, and here was a breakout. This resistance automatically became the support. Here you can see small trend line that was penetrated by small wick, the small shadow of the candle, but then price recovered and went higher. So it's much easier for you to see all those details with naked chart, with minimal details and so on, without, as I said, flashy stuff. And it's much more profitable approach than you can see on the right side. So what crucial thing do we need on our charts? Of course, it's a name of the asset, where we can choose the asset which we want to observe. Time frame, we want to choose time frames from 5 minutes to 1 day as minimum. Candles, of course, candles, because it's a chart, yes. So it's a full diary how the price moved. Price of the asset and vertical volumes. I encourage you to, if you don't use vertical volumes, to start use them, because it's the only indicator that really brings money. It's very helpful, and just try it. Of course, I need to say a few words about time frame. So what is it? Time frame is the interval of time that each candlestick or bar represents on a chart. So basically, by choosing time frame, we choose the time in which we want to see how the price was moving. One candlestick represents chosen time frame. For instance, 1 hour means that one candle will show how the price was moving during one specific hour. If we choose 15 minutes time frame, it means that one candle will show us how the price was moving for specific 15 minutes. I know that it's hard to catch all the information only with my voice, with sounds. That's why I created this visual example. So here you can see on the left side the chart of BTC Bitcoin with 1 hour time frame, and on the right side you can see the same chart of the same asset, it's Bitcoin, but 1 minute time frame. So here on this frame, in this frame, you can see 60 candlestick of 1 minute time frame shows the price was moving for last hour. That all movement represents that one candle. So it's like a Russian matryoshka, yeah? So one inserts in another one. So here you can see that the price moved up from 47,600. Here is this level. There was a growth. And then this movement downside represents only one red candle here on 1 minute time frame. So here from 5 o'clock 17 p.m. there was a switch of time frame, switch of candle here, and that's why we see this red candle. So the price moved downside, and all that movement was from 16 p.m. it's 4 p.m. so the price moved up. Yes, so it represents only one green candle. I hope it's clear. I often hear a false belief from somebody that scalpers use only time frame of seconds. It's not true, it's total bullshit. The main time frames for scalpers are 1 day, 1 hour, 5 minutes and 1 minute. And we use time frame in relation to the volumes that are in the asset. If the market is not active without volumes, it means that firstly we use 1 day or 4 hours even to analyze a general picture of the asset. If the market has volumes, the market is active, we switch our time frame to 5 minutes or even 1 minute time frame. Of course, I can't forget about candles. Candlestick shows us visual changing of the price in certain period and contains 4 price points: open, close, high and low. candlestick consists of body and shadows below and above the body. So what is the main difference between a long candle and short candle, or green candle and red candle? Of course, it's opening and closing of the body. So green candle or long candle opens always in the lowest point of the body and closes always in the top point, with red candle or short candle always opposite. The short candle opens always at the top of the body and closes in the lowest point of the body. Here I created a separate slide about volumes because, as I said before, they are crucial, and here I will tell you a little tip that will help you increase your profits in your trading. So what is the volume? Volume is an amount of coins or money that were traded in a certain time. So we are interested not just in big volumes in the asset, right? Because big volumes are on Bitcoin, Ethereum, or big cap coins, yes. There are always big volumes of trading, but we are interested in their changing. When volumes have increased twice in one day, it is a huge sign to pay attention to that asset. So, for example, we have a low cap coin, for example, below 100 millions of dollars. And if the volumes increase twice in one day, it's a huge sign to open the chart of that coin or that asset and just observe, because there are always players or one player, and there are always more setups for trading. We are interested in movement, not in the price of the asset. Yeah, we aren't investors. We need movements, because movements are our bread. Yeah, it's our profit, it's our money. If you see a huge increasing in the price, if you see a huge increasing in volumes in short period of time, it means that there will be a player or group of players, and you will have much more chances to make good trades. So here's the tip: trade coins that have big increasing in volumes in short period of time. Let's talk about risk management. It's one of the main pillars of successful trading. The main goal of risk management is to make your losses smaller than your profits. I saw so many people that do this completely opposite. They maximize their losses and minimize their profits. It's kind of funny, but it's just a reality. Losses are inevitable part of trading, and you have to be used to it. It's impossible to always have profitable trades, and that is a problem of maybe 70% of traders. They can go along with their losses. It's just inevitable part. You can't make always only profitable trades. For losses, you always have your risk management, so your losses are always smaller than your profits. Then the main thing. We never know for 100% where the price will go. It's just impossible. Trading is based on theory of probability. Our job is to find setups that have the biggest chance of the execution according to our plan. So we have setups that we know that they have a biggest chance of execution according to our plan. Yeah, we don't trade a random shit. We trade only our setups. And that is one of the key of success. Maybe you hear a wonderful phrase from Matthew McConaughey in the notorious film Wolf of Wall Street. He said, "Rule number one of Wall Street: nobody, even if you are Warren Buffett, nobody knows if the price is gonna go up, down, sideways, or in fucking circles. It's all a fugazi." What did he mean by that? It's you can predict the price. You can't know for 100% where the price will go. So the only salvation of this is proper risk management, because without the risk management, you are doomed. The market will destroy you. So it's the main part of trading to be sure that your losses are always smaller than your profits. It's very simple thing, but it's a huge problem of traders. So just remember this, okay? I separated this section into 4 parts. Here you will find out what initial deposit you should have, when to open the position, risk per trade, and what is RR, risk reward. Let's talk about your initial deposit. If you don't have a solid amount of savings, don't worry, because there is no point to rush into trading with big sums. Start with some that you are ready to lose. It can be $100, $1,000, $10,000. All depends on what amount won't make a big impact on your life. If you don't have any experience and start on your own, I would recommend to begin with $100. It's enough to test the water. Big percentage of profitable traders started from $50, $100 and accelerated their deposits to $100, $500K. As for me, I started from $40. When to open your position? Before you open your position, you have to know 3 things. First one is price of opening position, entry point. Second one is price of take profit, and third price of stop loss. Pay attention to third part, price of stop loss, because when you don't know where is your stop loss, you don't open your trade. It's impossible, because you have to calculate your risk before you open your position, not at the moment of opening position. And it's one of the most important things that you can learn. Here on the picture you can see a setup of breakout. Here you can see the entry point, you can see stop loss and take profit. What I want to say that take profit is always different. Potential of take profit is always different. It depends on stage of the market, the phase of the coin and other things, but you can control this. Yes, it all depends on other factors, other stuff that you can't control. Yes, what you can control is your entry point and your stop loss. It's your risk. Only risk is controlled by you. So if you don't know how to control your risk, you won't be a successful, profitable trader. Let's talk about risk per trade. If you don't have experience, I don't recommend to lose more than 2 or 3% of your deposit per trade. So it's your stop loss. If you enter into position, your stop loss must be not bigger than 2 or 3% of your deposit. So for example, if your deposit is $100 or $1,000, your stop loss shouldn't take more than $20 or $30 from your initial deposit. Second, don't use leverage bigger than 5x. What does it mean? If you have the same deposit 1,000, don't use the leverage bigger than 5. That means in your position you don't use volume bigger than 5,000, because 5x is 5 multiplied by your initial deposit that was 1,000, so it equals 5,000. So don't enter into position with volume higher than 5,000. Experienced trader knows when to take bigger risk because he knows that potential profits could be significantly bigger. When you will have some knowledge, experience and so on, you will know what situations can bring you more money, so you can take bigger risk because risk reward is much bigger, and only then you can take bigger risk. About the phrase, there will be millions of opportunities to make money, but it wouldn't matter if you won't have money to use them. That phrase should be on a wall in the most visible place. The market gives a huge amount of opportunities to make money every day. Don't rush into first best trade setup, because you will collect a huge amount of stop losses, and then instead of earning money on a good phase of market or coin, you will be forced to recover your deposit to initial size. So instead of recovering, take care of increasing your deposit. Okay, just imagine that on your setups that you understand, that you know how to trade, instead of earning money, you just recover your deposit to initial size. What is the point? Okay, so take care of your deposit. When to open a position. So for example, we have the same setup for breakout, and we have a stop loss of 2%. So how we can quickly calculate how much money we're gonna lose if the price will hit our stop loss. So for example, our initial deposit is 100%, and let it be $500. Stop loss, as I said before, 2%. So how much money we will lose if the price will hit our stop loss? The formula is super simple. It's our deposit, it's 100%, $500, multiplied by 2% and divided by 100%, and it equals $10. So we take our deposit, multiply by our stop loss, can be 1%, in our case it's 2%, it's 1,000, and divide by 100%, it's $10. So here is the example how quickly we can calculate our stop loss for every trade, because it is crucial to know how much money you're gonna lose if the stop loss will be activated, and from this place we can build our risk management properly. Let's talk about risk reward, or RR. Risk reward is a ratio between your stop loss and take profit. In other words, it's how much you are willing to lose in order to earn. If you risk $100 to earn 50, it's a disaster. Chances to survive here are 0. It would be great if your average RR will be more or equal to 1/3. It means that one successful trade recovers 3 negative trades. So for example, we have a trade and our potential take profit is 6% and stop loss is 2%. So how to calculate our risk reward? It's stop loss divided by take profit. So it's 2% divided by 6. We can cut down this number and we will get 1/3. If the setup has 1/3 RR, so we can accept it and try to trade. So let's calculate our risk reward on the previous example. So here is the setup that we saw before. Our stop loss is 2% and take profit is 28% from entry point. So how we can calculate risk reward? We take our stop loss, it's 2%, divide by 28%. And if we cut down this number, we will get 1/14. As you remember, our initial deposit was 500. Let it be the same amount of our volume in position. So we entered in the position with volume 500. It's position size. We calculated before the stop loss. Stop loss equals 10%. And now we see that stop loss or take profit is bigger than the stop loss in 14th time. Yeah, so we can easily multiply 14 by 10 and we will get 140. So it's amount that we will get, that we will earn in order if the price will hit our take profit. So we risk only 10% to earn 140. As for me, this trade is wonderful because you always want to have such big ratio between your risk and reward, because you can recover 14 trades with negative results by one winning trade. So always look for good risk reward trades. Okay, so where to start trading? Many new traders usually stand at a crossroads. They don't know if they should start with paper trading or real trading. I won't explain you what is real trading is because I hope you already know this. And let's talk about paper trading. So basically paper trading is the same trading as a real trading, yeah, but with fake money. So in general, you need only a chart to observe your asset, your coin, and sheet of paper with pen to write down your entry point, your take profit, your stop loss, and of course volume which you will use in your position. Nowadays many exchanges have simulation of real trading, so you can practice to click buttons, and it's risk-free for you. And from one side it's great, yeah, I have to agree, it's great. Also, many gurus encourage their students to trade only on demo accounts, like simulations, because as I said before, it's risk-free, and you won't lose your own real money. And here is a paradox, because Guru gives you, for that period, Guru gives you useless information which you can implement in your training, and you get euphoria because of course you will get some winning trades. You will see a huge volumes in your positions, like thousands, millions. Also profits will be also big, hundred thousands, millions, and you will get that euphoria. You will think that, oh, I will crash the real market. And when you want to switch demo account, your simulation, to the real trading, start to trade with real money, those people are fucked up. Yeah, because when you start trading with real money, one thing wakes up. It's your emotions and psychology. The problem is hidden in your emotions, aka psychology. When you trade with fake money, your brain takes this like a game, so your psychology doesn't make any impact on your actions. But there is always a word but. When you close your position with profit or loss with real money, you will always get some emotions, yes, and they can be a positive or negative, and they make incredible impact on your mental state, and mental state makes a huge impact on your actions. You have to trade with real money to get real emotions, because when you trade with fake money, you don't have such big impact on your psychology. You just have a mental masturbation by seeing a huge numbers in your positions, and you don't have any progress from that place. And it's crucial to start to trade with real money, even with I don't know, with $50, $100. Let it be a sum that you can let yourself to lose, yeah, but you will feel how you lose your real money. Let it be $5, let it be $2, yeah, of stop loss, but that's $2 will make bigger impact on your psychology, on your emotions, than 2 millions of loss, yeah, by stop loss or loss with fake money. So I encourage you to trade with real money. Let it be $20, but those money must be real, okay? So if you ask me, do you need a paper trading? I will say no, you don't. Just take this little amount of money, $20, $50, and start to trade. You will gain much more experience by earning and losing real money. Let it be $2, $3, $5, 50 cents. It will create a bigger impact on your trading skill than just trading with fake money. Okay, so just make a small deposit and don't be afraid to lose it. Yeah, it's just investing in your experience, yeah, in your skill. So it's much more better to trade with real money than with fake money. Here I want to add a few words about real trading. Without mastering your emotions in real trading, your strategy, risk management, and other necessary things doesn't matter at all. You can practice for half of the year, 1 year, 2 years, 3 years of paper trading, but when you will decide to switch to real trading, to enter in a tough real world of trading, you will constantly get punches into your face because you didn't master your emotions. Your discipline isn't on the same level as your strategy, risk management. You can have a super strategy, like a great trading strategy that you can implement on every stage of the market, into the to the every phase of the coin. You can have a great risk management with paper trading and so on. Have an incredible risk reward ratio, but that stuff won't work if you can't stick to your plan, if you can't stick to your trading strategy. Yeah, you have to master your emotions because they always appear in the time when you are in stress, and your preparation is super important, because in a stress situation, yeah, when you have adrenaline in your veins, in your blood, you will act according to your preparation, not to your expectation. So please just deposit $20, $50 and start to trade with real money. So we talked about risk management. Let's talk about cycles of the market. From the very beginning, the market runs in 4 cycles: accumulation, markup, distribution, and markdown. When the last one is finished, all cycles are repeated again. These 4 cycles will exist as long as the market exists. Here you can see a chart of Bitcoin 1-day time frame. You can see 4 cycles: accumulation, markup, distribution, markdown, and accumulation again. But why the market is so interesting? If you look closer, you will see that all charts are just fractals, and large fractals are composed of small ones. So if we just zoom in this chart at this place, you will see the same 4 cycles: accumulation, markup, distribution, markdown, accumulation. Cycle, yeah, one cycle. One cycle of 4 cycles. Then again, accumulation, markup, distribution, markdown. And here will be accumulation. So the large fractal composed of 2 smaller ones. In crypto, we often use a little bit different terms. So instead of accumulation, we say consolidation. Instead of distribution, we say consolidation again. Markdown, it's downtrend, and markup, it's uptrend. I'm just saying this to make the picture more clear, because on a daily basis, most of traders use terms that are in the right side. So here you can see on a picture the same chart of Bitcoin 1-day time frame, but I changed the terms. So here is the consolidation, uptrend, consolidation, downtrend, consolidation again. Uptrend, consolidation, downtrend. So it's all the same. And what is interesting here, that we have a candle, and take a look at the chart of that candle. If just imagine that this candle is, for example, 1 hour, yeah, 1 hour time frame. So we have open point, yes, we have a consolidation, then we have a manipulation that creates a low of this candle, then we have uptrend, a little pump that creates a high. It can be also a false breakout, pullback, and consolidation, and close. And here is a great example how one picture just consists of small ones, of small fractals. Okay, now let's discuss quickly what is a trend. Trend is the price movement of a financial asset in one direction. It shows the disbalance between sellers and buyers. Trend can be of two types, uptrend and downtrend. Uptrend. Uptrend is the price movement of a financial asset when the overall direction is upward. In an uptrend, each low is higher than previous one. So we have first low and second, and you can see that second low is higher than previous one. The uptrend is therefore composed of higher lows and higher highs. As long as the price is making these higher lows and higher highs, the uptrend is valid. We have higher high, higher low, higher high, higher low. As long as the price is making higher high and higher low, the uptrend is valid. Uptrend shows that demand is bigger than supply, and here is maybe the most important thing. You have to remember that demand is bigger than supply in uptrend. Here you can see two examples of uptrend. On first example, you can see low, higher high, higher low, higher high, higher low, high. And if you will try to provide a trend line, imaginary trend line with the chart, you will see that price doesn't penetrate the trend line, so the uptrend is valid here. On second picture, you can see more aggressive uptrend. Here was a consolidation, breakout of consolidation, fast consolidation, breakout, uptrend. It's aggressive uptrend, consolidation, uptrend, and here was the algorithm that pushed price higher. Here you can provide a normal trend line because price just skyrocketed, but you can clearly see by your eyes that here is an uptrend because we have higher high, higher low, higher high, higher low, higher high, higher low, and high. So that uptrend is valid. Downtrend. Downtrend is the price movement of a financial asset when the overall direction is downward. In a downtrend, each high is lower than previous. Second low is lower than first one. The downtrend is therefore composed of lower lows and lower highs. As long as the price is making these lower lows and lower highs, the downtrend is valid. So we have lower low, lower high, lower low, lower high. As long as the price will make this lower low, lower high, lower low, lower high, the downtrend is valid. Downtrend shows that supply is bigger than demand. It means that sellers are stronger and in that particular certain time than buyers. Yes, so we have to remember this. Next one, real examples of downtrend from real charts. So on the first chart you can see high, lower low, lower high, lower low, lower high, lower low, lower high. So if you will provide the trend line, you will see that here will be a small breakout. So here, as I remember, there was a consolidation after that fractal after this part of the chart, but here you can clearly see the downtrend to this point because each high is lower than previous one. Here is it's more aggressive downtrend. Here it's not so aggressive. As you can see, there was a dump, then price recovered a little bit, and there we have a downtrend. So we have high, lower low, lower high, lower low, lower high, lower low. So here we can easily provide the trend line, and we can be confident by 100% that it is the downtrend. Consolidation. Consolidation is the price movement of a financial asset when there is no overall direction. In other words, there is no trend. The consolidation shows us that demand and supply are in balance. That's why the price stays in narrow range. Most of the time, assets are in consolidation. I would say 80% of time, all coins, all assets are in consolidation because To have uptrend or downtrend, pump or dump, we should have players, other participants with big amount of money to move the price. That's why we have only 20% of active market, yes, when we can take good breakouts, bounces, pullbacks, and so on. And in active phase, when the coin just stays in narrow range in consolidation, and we just plan our trade, our setup. So, for example, here we can trade only bounces from upper or lower limits of that range, but as for me, it's not so interesting for us. Here we can see a real example of consolidation on the real chart. So we can see that the price just staying in this range. What we can do, we can just trade inside of this range. If the range is 10%, for example, it is possible, but if the range is so small, like 1% or 2%, there is no place for good movements, so it's better just to wait until the main movement will appear. So what we can do here, just try to enter here somewhere on a lower limit of the range, yeah, for example here, here, or here at the squeeze, and try to take a breakout from that range. So it will be a wonderful trade. We enter here by smaller part, it can be one like a half of the general volume that you want to load in your position, and here you enter at the moment of breakout, you add another part and you take this breakout. Yes, so can be depending on the duration of consolidation, it can be easily like 3 or 4%. Yes. Trendline. Trendline is the line that represents the direction of a trend, whether it's an uptrend or downtrend on local and global scale. So trendline is valid on 1 day time frame, 4 hours, 1 hour, 5 minutes, 1 minute, 5 seconds, doesn't matter. Trendline is always valid, like it's always working on whatever time frame you want to use it. So here you can see how the price perfectly bounced every time from that trend line, so that trend line is valid. Here's the same story. As I remember, it's a chart of Bitcoin of 2022 in August or September. So there was a funny situation because there was a breakout of the trend line, and as you can see here, the price rapidly moved up, and many traders that wanted to short that movement were fucked up. So trend lines can also serve as a critical support or resistance. So as I said before, you can easily plan your trade with trend lines for breakouts, for bounces, and etc. Horizontal level. Horizontal level is a horizontal line on a chart of asset that represents the resistance or support. It shows places of disbalance where one of the sides has more power than another. So each bounce from horizontal line or horizontal level, you can see that in that place the buyer is much stronger than seller. That's why the price just bounced rapidly from that place. As you can see, there is no any penetration of the line, so horizontal level is valid. Here's the same story. You can see how the price just perfectly bounced every time from that line. And as I said before, you can plan, as was with trend lines, you can plan your trade for bounces or breakouts. Finally, now we get to the really hot stuff that is the most valuable for you. How to take money from the market. As I'm a trader, algorithms of TikTok, YouTube, Instagram structure my feed in that way that I often come across videos, content related to trading. And I'm curious what those influencers are talking about, what information they provide to their audience. And holy cow, no one among them doesn't explain concepts of making money. They just don't tell you how to make money on the market. They just show potential setups. Maybe they talk about trades that they already executed, but they don't tell you how to make money on the market. Maybe I just didn't manage to come across somebody who can really explain this stuff, but I don't know. Maybe they just sell that information for huge money, because without that knowledge, it's hard to find your edge and build your strategy around that edge, around that concept of making money. And with this process, it's easy to, not easy, but it's much easier to become a profitable trader. So now I feel obligation to explain you all possible concepts of making money. In general, we have 3 concepts of making money, but firstly, I want to read this quote. Market doesn't generate money, it distributes them. What does it mean? Market, it's not a factory that can produce a product and sell it. Yes, it doesn't provide services, so it doesn't generate money by itself. Only other participants can bring money to the market and you can take them. So it's just a place of exchange between different participants. Yes, so if you want to take money, you have to come and take them. Market won't give you money just because you are a cool guy. Yes, so remember, market doesn't generate money, it only distributes them. So if you want to make money on the market, you have to learn how to take money from others. Okay, so now about concepts of making money. First one, when somebody loses. Losses of the majority of participants of the market are our profits. Second, when big players implement capital in their aims. Market makers, big investors, hedge funds, institutions, etc. And last one, when you get ahead of the herd. You manage to enter into the trade before the majority of participants. There is no other options how to get money in trading to your pockets. By understanding these methods, you will be on halfway to the profitable trading. Now I will explain each concept based on examples of my trades. Let's start with first concept, when somebody loses money. The most classic situation when somebody loses money are breakouts. Breakout is the situation when the price intensively crosses the upper or lower limit of consolidation, aka horizontal level. So here on the screenshot you can see a consolidation and small horizontal level. Here I entered with smaller part of my position, and when I saw confirmations for my setup, I added the main volume and took this trade. Yes, took the breakout. So why somebody loses money? Because traders leave their stop losses under or above the structure, aka pattern. When the market price reaches the price where stop losses are placed, positions of those traders are closing automatically. That causes intensive selling or buying of the asset. So here on the screenshot you can see the same consolidation, like it's another screenshot, another chart, but the concept is the same. You have consolidation, you have lower horizontal level and breakout. So here was under that structure, under the consolidation, you have stop losses of other participants, of other traders that expected that price will go higher. So if you enter somewhere here or here, you, to be honest, you always place your stop loss under the structure or consolidation. and when the price will reach your stop loss, it will be activated and cause the selling pressure. Here is the example of that concept. There is such thing that called the chain reaction or domino effect. Each activated stop loss pushes the price lower or higher, depends on the side, and the price moves to the next stop loss orders that cause even bigger breakout. So what we have here? We have a consolidation, breakout of lower limit of consolidation, and as I said before, we have stop losses of participants, of traders that tried to take a long setup from that consolidation. And when the price will hit their stop loss, it will create a selling pressure that will push price lower. That's why we have a domino effect. And when the consolidation have, for example, 1 hour, 2 hours, 4 hours, 1 day of just consolidation in narrow range, we will see bigger movement because more traders will enter into position, because more traders will see that setup and they will take a trade, they will place their stop losses, and when the price will go in another side, in another direction, it will activate their stop losses and create a huge squeeze or dump, rapid movement of selling pressure. I hope it's clear. Details you should know about that concept. Not every horizontal level has stop losses above or under it. Don't expect that from every horizontal level you will get a huge impulse of breakout and make money. No, it's not working that way. It all depends on the coin which you want to trade, the phase of that coin, stage of the market, duration of consolidation, etc. So don't expect from every horizontal level a huge impulse of breakout, okay? That won't work if you try to trade that coin with no participants. It's just it's a core of that concept. If the coin is dead, there is no participant, so how you can take money from somebody if there is no participants? Like it's there is no logic. Yes, so skip that coins. You need coin with participants, with players. Horizontal level should be a line, not a wide range. When you have a consolidation and clear level, it's much easier for other participants to place their stop losses right above or under the level. So when the price will reach, for example, the horizontal level is on $5, where you will place your stop loss. Of course, at $5.01, $5.02. So it's very narrow range of like a zone of stop losses. So it's easier for a price to reach those stop losses and create pressure to move the price higher or lower, depends on the side. And when we have a wide range of support or resistance, it's hard for the price to reach each order, yeah, because for example one order is on $5.01, other stop loss order is on $5.10, so they are placed on big distance and it's hard for price to reach all of them, and there won't be a chain reaction or domino effect. The potential of breakouts is always different. It depends on the duration of consolidation, behavior of the asset, market conditions, and etc. As I said before, in the first option, when I said a few words about horizontal levels, that they won't work every time. All depends on the phase of the coin, stage of the market, the duration of that consolidation, etc. So if we have the bull run, yeah, it's uptrend or straight downtrend, yeah, aggressive downtrend, that concept will work perfectly because there is huge amount of participants, of players, there are traders who can potentially lose money. If the market is inactive, we are in a flat market, etc., it won't work as it should be. Second concept of making money is when big players implement capital. If we talk about big players, in most cases it's manipulations. It's all known pumps and dumps on assets, patterns, shakeouts, etc. The aim of Big Boy is to involve as many traders as possible in active trading so that they help him to fulfill his goals. By using huge amount of asset, the big player can easily draw whatever pattern he wants on a chart. So what manipulations do we have on a chart? Pumps. Strongly recommend to look for entry point on pullbacks in long direction. Loss dragging and averaging is not recommended. Never open short position on pumps with the only confirmation such as this asset grew too much. If you are a beginner, I strongly recommend to skip those situations because there is more chances to get a punch from the market into your face than to earn, especially if you want to short that movement. I know that by logic, our brain tells us to go short because, as I said before, this asset grew too much, but it doesn't work that way. There will be always such coins like Unfi, TRB, people, yes, that can make 6x from initial price in 3 hours, 4 hours. So what you will do if you start averaging every time when you will see a pump? Yeah, so what is averaging? Basically, you see a pump, you go short, open your position in short direction, but the price doesn't go lower, yeah, in short direction. It's a pump. So you will start averaging, so you go short again, and your entry point will go higher, but also you increase the volume in your position. So in the end, you will just liquidate your deposit. You will kill your deposit. It's better just to take those money and throw into the fire. It's the same process. So please just think twice before you will do such dumb shit, okay? There is no reason to take such big risks to earn a few bucks. It's not worth it, really. So my recommendation, just try to enter on the pullbacks if you will see them, or just keep it, okay? And just take a look at this chart, at this screenshot of coin people. You can see how the price in 1, 2, 3, 4 hours made 6x in 4 hours. Just imagine what will be with your deposit if you will try to short that movement. I think that consequences would be terrible. And John Maynard Keynes said one wonderful quote: "Markets can remain irrational longer than you can remain solvent." It means that even if something going on uncommon on the market and you don't think it's totally wrong, you shouldn't argue with the market because it will take away all your money, all your deposit, because you are just a tiny fish. You are plankton in the huge ocean. About irrational movements on the market, I just remember this coin. It was ape. Yeah, it's ape. It's project with monkeys, maybe you remember. So it basically just just images with monkeys, but they cost a huge amount of money. Like I remember 200,000, half of the millions of dollars, and it was on hype. And for a few weeks, it was an incredible, just incredible growth of that coin. And you just think for a second, like, what the fuck? It's just a scam, yeah. It's obvious. And why it's growing? And you try to short that shit because it's really shit, and it's not working that way. You will just lose money. So you have to work with trend. Trend is your friend. So don't short pumps. Just try to take long trades with that movement. Okay, don't argue with market. Also, what I have to add here is dumps. Dumps are opposite action to pumps. In the first example, player buys the asset in just enormous amounts, and in dumps, player is selling the asset in just huge amounts. So basically it's the same. The mechanic is a little bit different because of the short position and long position. I say this before, but in general it's the same stuff. Next are shakeouts. Shakeout is a rapid, unexpected movement for majority of participants. The main goal to force traders to close their positions. In 80-90% of the time, price will return to the values that were before the shakeout. How does it happen? Participant or big player throws the market order that is bigger in couple times than nearest liquidity in the order book. I will explain this on a real example on next slide. Let's talk about screenshots that we have here. So basically there was a uptrend, and a majority of traders expected that the price will go higher. So there was a little pump, consolidation, and the majority of traders thought that the price will go higher, especially after those big shadows of the candles. But big participants of the asset just sell a huge amount of coins and created that not so big but shakeout. So what basically shakeouts do? They force traders to close their positions. Somebody just sell a huge or buy a huge amount of coins, asset, creates this unexpected movement. The player activates all stop loss orders of other participants, and in that way he just shake out them from that asset. Here is the same story. There was uptrend. You see also this huge manipulation, helicopter, consolidation, and as for me it's set up for long trade. But as you can see, there was a huge shakeout for all traders who expected the continuation of uptrend. So basically you can see how it works. And here is the real example. I want to open a short position at the entry point of $73.74 with the size of position 100k. Basically sell the asset for 100k. I will immediately push the price to the point of $73.64. Why? Because here is the market price, yes. I want to short the coin, this asset. So basically what I do, I just sell it. I want to enter with 100k, so I will sell the asset with the amount of 100k. I must take a liquidity from the order book, yes, so the exchange will fulfill my order. So in general, I will take all that liquidity to this line because it equals to $98,000. So I will create immediate, like a rapid squeeze to that point, to that level of price. And that's how all squeezes, all those manipulation, rapid movements are created. You just buy or sell a huge amount of coins. the liquidity of the asset is so low that the exchange can't fulfill your order in small distance from the market price. That's why you collect all that liquidity, because all those orders, if you sum up all those orders, you will get my desired amount of coins, the volume with which I want to enter into the trade. That's why I collect all those orders, and the price will appear here. Okay, I hope it's clear. And last concept of making money is when you get ahead of the herd. I separated that concept from others because it's totally another work of art of entering before the main movement occurs, and that strategy is different from others. So the main logic is to enter before the main movement occurs. These trades can be implemented in day trading, scalping, and in swing trading. What is the main? You must know that somebody will buy after you. So here on screenshots you can see that there was a consolidation, and I entered not at the moment of breakout when the price crosses the line of consolidation of upper limit. Yes, I entered before because it's 1 hour time frame. Okay, and I took this trade. Second screenshot is the same. I entered before the main movement occurred. Okay, that is the concept. So for example, there are some rumors about certain project that it has a new revolutionary technology for blockchain. Okay, so it's our rumors. We know that the conference of that project will be, for example, 22nd of May. Okay, so a few days before we buy that asset, we buy. Then we wait for the conference. When the conference started, they announced that they really have this new technology. So at that moment, thousands of people will buy their asset, and you will be already in that rocket. So all what you have to do is just close your position with huge fat profit, or just hold your position for a bigger trade. Why this concept is so great? Because the chances that somebody will buy after you are extremely high. So it doesn't take a huge amount of time. You just enter, place your stop loss, and just wait. It's not as scalping. Yes, it's more for swing trading, for spot, but it's very profitable concept, and you have to know how to use it. Last but not the least, advices for those who really want to succeed. First one is clarity. You have to know what you're doing from point A to point Z. If you have a mess in your head, if you don't know what you're doing and you just blindly enter into every trade because you bought crypto signals in Telegram channel, sorry, but you don't have chances to succeed here. Second, entry and exit. You must always have a reason to open or close the position. Trading without confirmations is just gambling. For gambling, you can go to the casino, for example. Yes, we are here to make money, not to lose them, right? Remember this. Third, strategy. Your strategy must be written somewhere: notebook, Word file, Notion, picture on the wall, etc. If you figure out your strategy in your head and you try to trade with your imagined scenario, sorry, but you have a tiny chances to implement it correctly, yes, and zero chances to improve it. Strategy must be material, it's not an error. Fourth, simplicity. Don't overcomplicate. The simpler the strategy is, the more chances to execute it perfectly. So if you use 20 indicators in your trading and everyone shows different information based on which you have to enter into the trade. So one shows that you have to enter, another one that you shouldn't, and you lay up on those indicators waves of Elliott, the net of Fibonacci retracement and other shit. So just imagine that mess, that chaos in your trading space, in your head. What I can say, you just can't succeed with such approach. I explained you 3 concepts of making money, and they are super simple. They just simple as it possible, yes. And the main, they work, okay? So just use them, make money, and don't look for additional pain for your ass, okay? So use them and make money. So my friend, I highly encourage you to subscribe to my social pages like Instagram, TikTok, YouTube, especially to my Telegram channel, because there I often post my trades, my personal trades. On social pages I often post valuable contents for which other people pay money, so it's really valuable information. And I just want to remind you that you can get a bonus section to this course just by leaving a meaningful comments under that video and reaching out to me. Links will be in the description. And cashback, if you want to receive 20% of cashback from your trading fees, please don't hesitate and contact with me. Okay, so a lot of love, guys. Wish you a green Pinel and see you soon. Bye.